nLIGHT just posted its best quarter ever, then guided next quarter down by roughly $17 million in shipments. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. nLIGHT gets graded and traded. So on the headline, revenue came in 5.12% ahead of estimates at a record $82.6 million, and that's up almost 34% year over year. And on the EPS line, they beat by 36%, swinging to 17 cents of non-GAAP earnings from a loss a year ago. That's a real operating leverage moment. So on the beat itself, this earns a B. Mid-single-digit revenue beat paired with a 36% EPS beat is a solid print, just not a monster. And on consistency, this earns an A. nLIGHT has been reliably beating quarter after quarter, and this print keeps that streak clean. Let's talk about the positives from the report. Total revenue hit a record $82.6 million, up almost 34% year over year. This is the directed energy and defense build-out showing up in the numbers. And products revenue, which is the higher margin part of the business, jumped 45% to a record $59.4 million. That's the piece that's actually driving the whole story. Adjusted EBITDA nearly doubled to $10.7 million from $5.6 million a year ago. That's what operating leverage looks like when volume finally scales. They now have $330 million in cash and securities after a $192 million public offering, and they paid the credit line down to zero. This is a fortress balance sheet now. And 6-month operating cash flow flipped from a $1.4 million outflow to a $30.4 million inflow. The business is self-funding now. So on profitability, this earns an A. Products gross margin expanded to over 41%. EBITDA nearly doubled, and they swung from a loss to real non-GAAP earnings. Every profit metric moved the right way. Now let's talk about the negatives from the report. Q3 revenue is guided to $63 to $73 million, midpoint $70 million. That's a sharp sequential decline from the $82.6 million they just posted. And the reason for that is supply chain. Management explicitly said about $17 million of products revenue got pushed out of Q3 into future quarters. Delayed, not lost, but the market will still react to the sequential drop. Q3 adjusted EBITDA is guided to just $1 to $7 million versus the $10.7 million they just delivered, and gross margin is guided down to 24 to 30%, driven by that lower margin development mix. Stock-based compensation ballooned to $11 million in the quarter, up 72% year over year. That's why GAAP still shows a small loss, and share count is now up to 57 million from under 50 a year ago. Dilution is real. And the concentration risk is real too. Aerospace and defense is now about 69% of revenue, so any single program slippage or budget action would hit the print disproportionately. This quarter's supply chain issue is a preview of that fragility. So on guidance, this lands at a D. The Q3 revenue and EBITDA guide is a material step down from what they just posted, with supply chain slippage called out explicitly. Even if the $17 million comes back later, near-term visibility just got worse. And on red flags, I'm at a C. The supply chain issue, the 69% defense concentration, and the ballooning stock-based comp are all real concerns that offset an otherwise clean quarter. Putting it all together, this was a genuinely strong quarter operationally. Record revenue, products margin expanding past 41%, EBITDA nearly doubling, and cash flow flipping to a $30 million inflow. But the Q3 guide is a real step down driven by supply chain slippage, and that's going to dominate the price action for the next month or two. The long-term directed energy thesis got stronger with the Joint Laser Weapon Systems contract, but the near-term setup is lumpy, so I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The third quarter guide down probably hands me a better entry than where this thing traded before earnings, so I'm not chasing here. I'd let the supply chain driven sequential drop get digested over the next 5 to 10 sessions before I commit any real money. Then I'd sell cash secured puts into that weakness while implied volatility is still fat from the reaction, picking up premium and a lower cost basis on a name whose directed energy story actually got stronger this quarter. So my play is simple. I wait and I sell puts. For my put strikes, I'm anchoring off the third quarter guide midpoint of $70 million in revenue and $4 million in adjusted EBITDA, treating that as the actual print. Anything below the low end at $63 million in revenue and $1 million in EBITDA would be a real negative surprise, and I'd expect more downside from there. So I'm only writing puts at levels I'd genuinely be happy owning, because with $17 million of pushed out products revenue expected in the fourth quarter or first quarter, getting assigned near current levels could actually set up a great long-term entry. Bottom line, I'm picking strikes I truly want to own. I'm holding my shares here because the quarter itself was strong. Record products revenue and adjusted EBITDA doubling tells me the underlying business is working. The $330 million cash position after the equity raise gives this company real staying power and validates why I own it in the first place. The third quarter weakness is coming from guidance, not from demand disappearing, so I'd only trim if my position size feels too big into what will probably be a soft print. For me, the call is straightforward. I hold my shares. The third quarter guide down tells me the market has a reason to fade any rally over the next 60 days, with sequential revenue dropping and adjusted EBITDA compressing to $1 to $7 million. So I'm keeping my existing covered call strikes right where they are. Rather than rolling them up and giving myself more upside, I probably won't get anyway. If my calls are already deep out of the money, I'd think about rolling them down and out to capture more premium against this softer near-term setup. My move is to keep the strikes and maybe roll down for more premium. My leaps thesis is actually stronger today than it was 3 months ago, with aerospace and defense mix at 69% and products gross margin at 41.2%. $30 million of operating cash flow over 6 months plus a fortress balance sheet supports the 12 to 24 month directed energy story I bought these calls for. I'd hold my existing leaps right through this third quarter weakness rather than taking profits, and only think about rolling up after the supply chain story stabilizes and that $17 million of pushed out revenue actually delivers. So for me, I hold my leaps through this. The press release actually confirms why I bought this in the first place. Record products revenue, expanding products margin, and the JLWS contract mention all validate the directed energy exposure I wanted. Averaging down is defensible for me on any real weakness that comes from the third quarter guidance reaction rather than a broken business. But I'm staging my ads in pieces instead of putting it all in at once, because the supply chain issues called out in the release could easily produce another downside surprise before the recovery shows up. My approach here is I add, but I stage it. Bottom line, This print earns a B- from me. The underlying business is clearly inflecting, but that Q3 guide down almost guarantees some near-term weakness while the $17 million supply chain slip gets absorbed. Thanks for watching, and I'll see you on the next one.